Hey there, fellow traders. Welcome to another deep dive into the world of trading. Let's cut to the chase. Trading isn't just about the highs, it's also about navigating the lows. Trading can be a roller coaster ride, full of exhilarating highs and gut-wrenching lows. And let's be honest, most people end up with their heads spinning, trying to make sense of it all. Get this, a whopping 70% of retail traders lose money. That's a staggering statistic, isn't it? That's right, 7 out of 10 traders walk away with lighter wallets, often feeling defeated and disheartened. So what separates the winners from the losers? What makes some traders succeed where others fail? It's simple: avoiding killer mistakes. But what are these mistakes, and how can you steer clear of them? These aren't just rookie errors. Even experienced traders can fall into these traps. Seasoned pros can fall prey to these pitfalls too, often with even more at stake. But don't worry, I'm here to guide you through this maze. Together we'll identify these common pitfalls. We'll dive deep into these trading traps, examining them from every angle. And more importantly, I'll show you how to sidestep them, ensuring you don't fall into the same traps. Get ready to up your trading game. With the right knowledge and strategies, you can turn the odds in your favor and become a successful trader. Listen up, folks. Trading isn't about luck. It's about skill, strategy, and discipline. But even the best laid plans can go haywire. Why? Because we're all human. We make mistakes. But in trading, those mistakes can cost you big time. We're talking about real money here, your hard-earned cash. So what are these trading landmines you need to avoid? Think of them as silent assassins lurking in the shadows of the market. They can creep up on you when you least expect it. From emotional trading to ignoring risk management, these blunders can sabotage your success. All right, let's get down to brass tacks. What are the most common trading mistakes that can torpedo your portfolio? First up, we've got chasing hot tips. Remember, today's hot stock can be tomorrow's dumpster fire. Then there's the dreaded FOMO, the fear of missing out. This can lead to impulsive decisions and buying high only to sell low later. Overtrading is another culprit. It's like trying to force a square peg into a round hole. It just doesn't work. And let's not forget about neglecting risk management. That's like playing Russian roulette with your money. Now let's talk about the elephant in the room: emotional trading. This is the silent killer of countless trading accounts. Fear, greed, hope. These emotions can cloud your judgment and lead to disastrous decisions. Imagine this: you see a stock plummeting and fear takes hold. You panic and sell at a loss, only to watch it rebound the next day. Or you get caught up in the hype of a rising stock, driven by pure greed. You buy at the peak just as the bubble bursts. Sound familiar? We've all been there. The key is to recognize these emotions and develop strategies to neutralize them. FOMO: don't let fear make you a market casualty. Let's talk about FOMO, the fear of missing out. It's a powerful emotion that can cloud your judgment and lead to impulsive decisions. It's that nagging feeling that everyone else is making money but you. You see the markets soaring and you feel like you're being left behind. You see your buddy bragging about their latest stock market win and you can't help but feel a pang of envy. It's natural to want to join in on the success. Next thing you know, you're jumping into a trade without doing your due diligence. You're buying stocks based on hype rather than solid research. You're chasing the herd, hoping to grab a piece of the action. But this herd mentality can be dangerous. But here's the thing: FOMO is a recipe for disaster. It can lead to buying high and selling low, which is the exact opposite of what you want to do. It's like trying to catch a falling knife. You're bound to get burned. The market can be unpredictable, and jumping in without a plan can be costly. The key is to stick to your trading plan and ignore the noise. Develop a strategy based on your financial goals and risk tolerance. Educate yourself about the market. Knowledge is power, and understanding the fundamentals can help you make informed decisions. Take a step back and breathe. Sometimes, the best action is no action at all. Patience can be your best ally in the market. Diversify your investments to spread risk. Don't put all your eggs in one basket. This way, you can weather the ups and downs of the market. Remember, the goal is long-term success, not short-term gains. Stay focused, stay disciplined, and don't let fear drive your decisions. In the end, it's about finding balance and making choices that align with your financial well-being. Don't let FOMO make you a market casualty. Overtrading: the road to ruin paved with good intentions. Here's a hard truth: sometimes the best trade is no trade at all. Overtrading: it's a slippery slope that can lead to financial ruin. It's like being a kid in a candy store wanting to buy everything in sight. You get caught up in the excitement of the market and start making impulsive trades. You're constantly checking your portfolio, looking for the next big opportunity. But here's the thing, every trade comes with costs. Commissions, slippage, and taxes can eat into your profits. The more you trade, the more you risk. Remember, patience is a virtue in trading. Neglecting risk management. Playing with fire in the financial markets. Let me tell you something, folks. Risk management isn't sexy. It's not glamorous. It's not the part of trading that gets your adrenaline pumping or makes for exciting stories at parties, but it's absolutely crucial if you want to survive in the market. Without it, you're just gambling, not investing. Think of it as your financial seatbelt. Just like you wouldn't drive a car without wearing a seatbelt, you shouldn't trade without a solid risk management strategy. You wouldn't drive a car without wearing a seatbelt, would you? It's there to protect you in case something goes wrong. Neglecting risk management is like playing with fire. You might get away with it a few times, but eventually you're going to get burned. You might get lucky a few times, but eventually you're going to get burned. The market is unpredictable, and without a safety net, you're setting yourself up for disaster. You need to determine how much you're willing to lose on a single trade. This is your risk tolerance, and it's different for everyone. Set stop-loss orders to automatically exit trades when they go against you. This way, you can limit your losses and protect your capital. Don't risk more than you can afford to lose. Always remember, the goal is to stay in the game long enough to see your strategy pay off. Diversify your investments to spread out risk. Don't put all your eggs in one basket. By spreading your investments across different assets, you can reduce the impact of a single loss. Educate yourself continuously. The more you know about the markets and risk management, the better equipped you'll be to make informed decisions. Join trading communities and learn from others. Sharing experiences and strategies can provide valuable insights and help you avoid common pitfalls. Keep a trading journal to track your trades and review your performance. This will help you identify patterns and improve your strategy over time. Remember, risk management is not just about avoiding losses, but also about maximizing your potential for gains. It's about making smart, informed decisions that will help you grow your wealth over time. So, buckle up, stay informed, and always manage your risks. Your financial future depends on it. The importance of a trading plan. Your roadmap to success. Listen closely, traders. If you don't have a trading plan, you're setting yourself up for failure. It's like going on a road trip without a map or GPS. You're just driving aimlessly, hoping to stumble upon your destination. Your trading plan is your roadmap to success. It outlines your trading goals, strategies, and risk management rules. It should include your entry and exit points, your profit targets, and your maximum allowable loss per trade. Think of it as your trading constitution, the set of rules you live by in the market. Turning the tide, a powerful strategy for trading redemption. So, you've made some mistakes. We all have. The good news is, it's never too late to turn things around. One powerful strategy is to focus on what you can control. You can't predict the future of the market, but you can control your emotions, your risk, and your trading plan. Start by identifying the mistakes that have been costing you money. Once you know your weaknesses, you can start to address them. Develop a set of trading rules and stick to them. Don't chase losses and don't let your emotions get the best of you. Lessons learned. Avoiding the mistakes that can sink your portfolio. We've covered a lot of ground today, but the key takeaway is this. Trading mistakes are inevitable, but they don't have to be fatal. By understanding the common pitfalls and developing strategies to avoid them, you can significantly increase your chances of success. Remember, trading is a marathon, not a sprint. It's about making consistent, disciplined decisions over the long term. So learn from your mistakes, stay disciplined, and never stop learning. The markets are constantly evolving, so you need to evolve with them. Join the conversation. Share your story. Secure your future. Now I want to hear from you. What are some of the biggest trading mistakes you've made? Share your stories in the comments below. Let's learn from each other and build a community of smarter, more successful traders. And hey, if you're serious about taking your trading to the next level, make sure to subscribe to my newsletter. I'll share my latest insights, strategies, and tips to help you navigate the markets like a pro. Remember, knowledge is power. Let's make some money.